All right, let's dive right into this explainer. Today we're taking a hard look at Zomato, the undisputed reigning champion of India's food delivery ecosystem and the mounting threats it's currently facing. Look, if you've been tracking the food tech space at all, you already know Zomato isn't just surviving out there, they've practically defined the market over the last few years, rewarding their investors handsomely along the way. But you know, in the tech world, being the king of the hill means absolutely everyone is gunning for your crown. And right now, the stakes for Zomato's stock have literally never been higher. We really need to look closely at the massive forces trying to pull this giant back down to earth.
Now, take a look at this number, 12.2. What's really interesting here is that this represents Zomato's current premium price-to-sales ratio. To put that into perspective, this is a sky-high figure, representing absolutely massive investor expectations. The market has priced Zomato not just for the dominance they have right now, but for flawless future execution. Investors are essentially betting that Zomato is going to continue to effortlessly fend off some incredibly tough, well-funded competition while simultaneously growing its profit margins. And as we know, when a stock is priced for absolute perfection, any misstep, any new competitor, or any regulatory hurdle can trigger a massive correction.
So the crucial question we're exploring today is this. Can Zomato actually maintain its crown and justify this massive premium valuation against a wave of unprecedented challenges? We're going to look well beyond the surface level of daily deliveries. Instead, we need to analyze what is essentially a multi-front siege, government-backed disruptions, a brutal quick commerce war, and looming regulatory walls that can directly hit its stock performance. Understanding these exact risk factors is absolutely essential for anyone trying to figure out if this sky-high valuation can actually hold up.
Let's start with Section 1, the reigning champ, Zomato's current peak.
We're currently looking at a classic food tech duopoly, where Zomato holds a commanding 55 to 58% slice of the entire market, leaving its primary rival, Swiggy, with the remaining 42 to 45%. Now, securing a 58% market share in a country as vast and complex as India is incredibly difficult. Zomato has successfully managed to translate its early mover advantage, relentless execution, and really deep pockets into a heavily fortified position that gives them immense pricing power today. This dominance is exactly why investors have been so overwhelmingly bullish, assuming this competitive moat is basically impenetrable.
But it wasn't always this lopsided. Zomato has systematically widened the gap since its 2021 IPO. Think back to 2020. They were essentially neck and neck with Swiggy at around 45% each. Honestly, it was a coin toss as to who would ultimately win the delivery wars. Today, though, Zomato has leveraged its capital and strategic acquisitions to turn that market share leadership into a staggering 2.5 lakh crore rupee market cap, leaving competitors scrambling just to catch up. So yeah, they won the first war. But the battlefield is rapidly shifting beneath their feet.
Which brings us to Section 2, Threat 1, the ONDC disruption.
So think of ONDC, the Open Network for Digital Commerce, as the great democratizer of the digital marketplace. It's a government-backed initiative designed to do for e-commerce exactly what UPI did for digital payments, break up monopolies. Instead of a restaurant being locked into Zomato's closed ecosystem, ONDC connects them directly with buyers through third-party buyer apps like Paytm or MagicPen. It completely decentralizes the entire power structure of food delivery. If this network gains massive mainstream adoption, the middleman gets bypassed entirely. And that is a terrifying prospect for platforms built completely on controlling that middle space.
Because at the end of the day, it all comes down to the margins. Traditional incumbents like Zomato and Swiggy charge restaurants a hefty 25 to 30% commission per order. ONDC charges a mere 2 to 4%. That is a massive difference. For a restaurant operating on razor-thin margins, getting to keep an extra 20 to 25% of their revenue isn't just a nice little perk, it's an absolute lifeline. This undercut severely threatens Zomato's primary revenue engine and long-term stock viability. If restaurants migrate to ONDC in droves to protect their profits, Zomato's take rate will inevitably have to drop just to stay competitive.
Now, to be fair, ONDC isn't without its growing pains. While it certainly democratizes commerce and fosters competitive pricing, which, hey, lowers food costs for you and me, it still faces some massive scalability and integration challenges. I mean, who handles customer service if the food is cold? Who's responsible for dispatching the rider when things inevitably go wrong? Right now, the sleek, polished experience of a dedicated app is still really hard to beat. But even with these friction points, ONDC fundamentally levels the playing field. It forces the established platforms to rethink their profit structures, or they risk losing their restaurant partners to this open network entirely.
Moving on to Section 3, Threat 2, the quick commerce war.
Remember when Zomato's acquisition of Blinkit was highly scrutinized? Well, it's actually proven to be a masterstroke so far. Blinkit is currently crushing the unit economics game with an EBITDA margin of negative 0.1%. That means they are practically breaking even in what is notoriously a cash-burning sector. Just compare that to Swiggy Instamart, which is bleeding cash at a negative 11.7% margin just to keep pace. Reaching near break-even on 10-minute grocery delivery is a massive achievement, and it's a huge reason Zomato's stock price has been so well supported. But, as we'll see, Zomato's lead in quick commerce is far from secure.
Because it's just not a two-horse race anymore. Enter Zepto. Zepto's incredibly aggressive expansion is turning what could have been a cozy, profitable duopoly into a three-way, fiercely competitive bloodbath. They're pouring massive amounts of venture capital into building dark stores all over the place and subsidizing customer acquisition. This intense competition is a major headwind for Zomato's stock. When three giants are aggressively fighting for 10-minute delivery supremacy on every single street corner, profitability is always the first casualty. Zomato's going to have to keep burning cash to defend its turf, which delays those massive quick commerce profits that investors are eagerly banking on.
Which leads us to Section 4. Threat 3. The invisible walls.
Beyond the direct competitors we just talked about, we have to look at the structural ceilings acting as invisible walls to Zomato's growth. And frankly, these are largely out of the company's direct control. First up is the looming reclassification of gig workers. If regulations shift to mandate employee benefits, insurance, and minimum wages for delivery partners, the unit economics of this entire business model could literally collapse overnight. Second, complex dark store licensing hurdles act as massive speed bumps, significantly slowing down Blinkit's physical expansion plans. And finally, there's the very real risk of market saturation. There are only so many high-spending urban consumers in Tier 1 cities willing to pay a premium for convenience. What happens to Zomato's aggressive growth narrative and that premium stock price when they run out of them?
Finally, Section 5. The investor verdict.
Looking at the financials, there is a massive divide currently separating our two titans. In fiscal year 25, Zomato achieved something many thought was straight up impossible in food tech, a 527 crore rupee profit. Swiggy, meanwhile, is still burning through immense amounts of cash, posting a 3,117 crore rupee loss as it heavily subsidizes its quick commerce growth. This stark contrast in financial discipline and execution perfectly explains why investors have rewarded Zomato with that massive premium price-to-sales valuation of 12.2 against Swiggy's 6.0. The market absolutely loves a winner that can actually generate cash.
So where does this leave us? Well, Zomato has undeniably built an incredible fortress. They've captured the market share, they found a path to profitability, and they're currently executing flawlessly on quick commerce. But just look at the horizon. As the Zepto-fueled quick commerce wars drain capital, as the government-backed ONDC changes the foundational rules of restaurant commissions, and as those gig worker regulations loom in the background. Is it 12.2x premium valuation truly justified? Can this Goliath continue to outrun the entire field, or is the siege finally closing in? That is the absolutely critical question every single food tech investor needs to be asking themselves right now.